All right, guys, I'm going to go over some things to help you with starting with Chapter 3 that will carry into Chapter 4 and 5 and so on. First thing you need to remember is you always are going to affect at least 2 accounts. Every transaction will affect at least 2 accounts. Okay, I'm going to teach you some key phrases here. So on the first one here, it says Ken Adams took $20,000 for personal savings and deposited the amount to open a business checking. Okay, the first one is deposit. Anytime we're talking about deposited money, we're talking about cash and bank, and that's why you see an increase to cash and bank. The second thing is when we're talking about Ken Adams and he's investing into the business, okay? And you'll notice that's the same name that's on the capital account. That means you're going to increase capital, okay? So both of those are increases, keeping the accounting equation balanced. On the next one, it says Ken Adams transferred a desk valued at $200. Anytime you're talking about Ken Adams doing anything and he's transferring, that's going to be an increase to owner's equity, and he's bringing in a desk, which is office furniture, which is why we increase office furniture, increasing both sides of the accounting equation. On this one, when it says Martin Incorporated issued a $3,000 check to purchase a computer equipment. Okay, when we're talking about issuing a check, that automatically means cash and bank. So anytime you see the word check, you're talking about cash and bank, and that's why we have a minus $3,000 in cash and bank for transaction 3. Okay, we bought a computer system. Okay, so that means we're going to increase office equipment. So they're both assets. One's decreasing, one's increasing the same amount, leaving your accounting equation balanced. On this one, another key phrase that you're going to see here is on account on number 4. On account means one of 2 things. You're either talking about accounts receivable or accounts payable. What you have to ask is somebody buying from us or somebody paying from us. Accounts receivable is an account that is used when we are going to receive money from somebody, meaning they bought on account from us. Accounts payable means eventually we're going to have to pay it. Okay? So on this one, it says Martin Incorporated, which is our business, bought a copier on account. Since we're buying it, we're going to have to pay it. It's accounts payable. Okay, and that's why we increase accounts payable by $1,200. Okay, and we bought a copier, which is office equipment, so we're increasing our assets, so we're increasing both sides of the equation. All right. So this one here says we sold 20 crates of paper to Green Company for $5.50. Okay, so we sold 20 crates to the company for $5.50. You'll usually see a phrase that says billed or again on account. Okay, if we billed them or they bought it on account, since we sold it, that means we're going to be receiving the money. So that means we're automatically talking about accounts receivable. Okay, so anytime somebody buys from us and we bill them or they bought it on account, then we're talking about accounts receivable, and that's why you see that $5.50. Okay, and we sold 20 crates of paper, which is our office equipment, so it's subtracting $5.50 from there. Okay, on this one, we issued a check. So tell yourself, what is that? If you said cash and bank, you are correct. Cash and bank. Okay, so we're going to minus cash and bank. And then it says partial payment. So that means we're making a payment to an account. So that means accounts payable. Because again, we're going to pay that account. Okay, as always, email me if you have any questions.